Welcome to the course, How to Invest in Options from Step-by-Step Investment and Business. During the course, you will learn how to invest in stock options using the most advanced strategies. The course is divided into 26 chapters. In the first chapter, we will analyze how stock options work. In the second chapter, called Options Strategies, we will discuss all the points that we must consider prior to initiating an options position. Next, in chapters 3 and 4, Long Stock and Short Stock, we will analyze in detail the positions that we can take to invest only in stocks. From chapter 5, Long Call, we will analyze the different positions that we can take to invest in options. In chapter 6, we will analyze the short call position. In chapter 7, we will analyze the covered call strategy. In chapter 8, we will analyze the long put position. In chapter 9, we will analyze the short put position. And in chapter 10, we will analyze the covered put strategy. From chapter 11, we will analyze more complex strategies, such as the bull-call spread. Chapter 12, bear put spread. Chapters 13 and 14, long and short straddle. Chapters 15 and 16, long and short strangle. Chapter 17, ratio call spread. Chapter 18, radio put spread. Chapter 19, call ratio back spread. Chapter 20, put ratio back spread. Chapter 21, long butterfly. Chapter 22, long condor. Chapter 23, long iron condor. Chapter 24, calendar spread. Chapter 25, diagonal spread. And Chapter 26, collar. We begin with the first chapter of the course. In this chapter, we will analyze how stock options work. An option is the right, but not the obligation, to buy or sell a specific number of stock shares at a specific price for a predetermined period of time. If the acquired right is to buy, the option is called call. If the acquired right is to sell, the option is called put. The options are traded through contracts. An option contract represents 100 shares of a company's stock. Options are part of the financial instruments known as derivatives. A derivative is a security whose price depends on the price and expectations changes of an underlying asset. As examples, in addition to options, there are swaps and future contracts. Let's see the definition of the two types of options we have: call and put. A call options contract gives the owner the right to buy 100 shares of an underlying stock at a specific price for a predetermined period of time. On the other hand, a put options contract gives the owner the right to sell 100 shares of an underlying stock at a specific price for a predetermined period of time. So, a call options contract gives the right to buy, and a put options contract gives the right to sell. This right, to buy or sell, is written on 100 shares. Let's see how to understand an option contract. In general, option contracts are called as can be seen here. Now, let's see in detail each of these terms. The first one defines the symbol of the underlying stock. In this example, the company is Apple. Then, it is indicated what is known as expiration month. It is the month in which the contract is no longer valid. The expiration date is the third Friday of that month. In the example, the expiration date of the contract is the third Friday of October 2011. Notice that the contract refers to October 2011. This is the month in which the contract expires. The specific day of that month in which the contract expires, by convention, is the third Friday of this month. Then, it is indicated what is known as strike price or exercise price. It is the price at which the stock underlying the call or put option can be purchased or sold at any time until the expiration date. In the example, the strike price is $390. And finally, it is indicated the type of option contract, whether it is a call or put. In the example, it is a call. So the contract we are seeing, called Apple October 2011 $390 call, is a contract that allows us to buy, because it is a call, 100 shares of Apple at $390 each until the third Friday of October 2011. It is important to mention that options that can be exercised at any time until their expiration date are called American options. On the other hand, options that can be exercised only on their expiration date are called European options. We will work with American options. Let's see how a call works. Suppose we have the contract called Apple October 2011 $390 call. The owner of this contract has the right to buy 100 shares of Apple at $390 each until the third Friday of October 2011. So, let's consider the following example. Suppose Apple is currently trading at $400. If we are the owner of an Apple October 2011 strike price $390 call, we have the right to buy 100 shares of Apple at $390 each until the third Friday of October 2011. Therefore, if we exercise the contract at this time, the person who sold it, who is called the option writer, must sell the 100 shares of Apple at $390. Thus, we can sell those 100 shares at $400 in the market, making a profit of $10 per share. That is, a total profit of $1,000. On the other hand, a put works as follows. Suppose we have the contract called Citigroup November 2011 $31 put. The owner of this contract has the right to sell 100 shares of Citigroup at $31 each until the third Friday of November 2011. Example: suppose Citigroup is currently trading at $29. If we are the owner of a Citigroup November 2011 strike price $31 put, we have the right to sell 100 shares of Citigroup at $31 each until the third Friday of November 2011. Therefore, if we exercise the contract at this time, the person who sold it, that is the option writer, must buy the 100 shares of Citigroup at $31. Thus, we can buy those 100 shares at $29 in the market and then sell them at $31, making a profit of $2 per share. That is, a total profit of $200. In general, we almost never exercise an option contract, whether it is a call or put. In fact, what we do is to sell the contract in the market because we make the same profits without the need to exercise it. Now let's talk about the price of an option contract. In order to be the owner of an option contract, whether it is a call or put, we must purchase it at the current market price. This price we pay is called the option premium. The option premium is the amount paid by the investor who buys the contract, and therefore it is the income received by the investor who sells or writes the same one. The premium of an option contract is expressed per share. Therefore, as each contract represents 100 shares, the total price of a single contract is 100 times the premium. For example, if the premium, of the Apple October 2011 strike price $390 call is $12, we must pay $1,200 to buy a single contract. If we want to buy two contracts, we would pay $2,400.